So today we're gonna focus on cash flow statement. Yeah, we will do the direct method, indirect method, and also this the reconciliation statement. This is what they require us to do. We'll first start with the direct method, and then we'll go to the indirect one at last. So the name of the business is Baron Stationery Pt.1 Ltd. We're preparing the statement of cash flow for the year ended 28 February 2021. So the first thing that we have to prepare is cash flows. Cash flows from operating activities, which is made up of cash received from customers and also cash paid to suppliers. From these two, we're gonna get what we call the cash generated from operations. Now let's deal with the calculations between the two. According to the calculations, we're gonna be having for cash received from customers. We're gonna talk about the opening balance of either trade and other receivables or debtors control. We add the revenue or the sales, then we subtract credit losses, and then again we subtract the closing balance of trade and other receivables. Yes. Yo, okay. So from our question paper, we have debtors control. We don't have trading other receivables. So we're gonna take the opening balance. The opening balance as there is it is 70,000. I'm gonna take 70,000 here. It is positive. It must be positive. Then you add sales or revenue. Then it must be somewhere else. Let's see. It must be, oh yeah, another income statement. They gave us the cost of sales as 1.8 million. So we have adjustment number 7. They told us the entity obtains a gross profit markup margin of 50% on cost. Starting with the markup. If the markup says on cost, this tells you your sales must be 150%, and then the cost has to be 100%. Automatically the gross profit will have to be, let's not forget our gross profit is sales minus cost of sales. It will be that 150 minus 100, which is equals to 50%. Coming here, the reason why I'm saying this is 150%, the way that guides you after the percentage, it says on cost has to be 100%. If it said on sales, your sales was gonna be 100%, your cost was going to be this 100 minus the markup, which means your cost of sales was gonna be 50%. Then from that, your gross profit will be that 100% from sales minus the cost price. Cost of sales is gonna be 50%. Hope is clear. Okay, let's get to the top. We have the cost of sales of 1.8 million. We are looking for the sales amount. The sales amount has to be 150%. We apply the accounting method, which says what you are looking for. Up top, what do you have? Camouflage. You have the cost of sales as 100%. You are looking for 150% from 1.8 million. So if we take a calculator, and then we take 1.8 million, 1.8 million times 150, we divide it by 100, we're gonna get the sales amount of 2.7 million. What is that? Yeah, the revenue here, the revenue is gonna be 2.7 million. 2.7 245 246 no, 2.7 million. If you take this and subtract this, we're gonna get the gross profit of how much? Answer minus 1.8 million. We're gonna get 900,000 as our gross profit. And remember, this is 50%, this is 100%, and this one is 150%. So we're gonna post it here. From here, we're gonna multiply by 150, we divide by 100, is gonna be 2.7 million. After that, we check if we have credit losses, but according to our question paper, it's not there, which means it's a dash. And then again, we subtract or less the closing balance of our debtors. If it's not debtors, it's gonna be trading other receivables. There it is. We subtract 95,000. So 70,000 plus 2.7 million. Gonna take 70,000. We add 2.7 million. Yeah, we subtract 95,000. We're gonna be having 2,675,000. So we can post it here on our cash flows. We have cash received from customers as 2,675,000. We must now calculate for cash paid to suppliers, the first method. Number 2, we're looking for cash paid to suppliers. The first method, the first thing that we must check is the method. When we are looking for cash paid to suppliers, this is the method. We first have to check net profit before tax. We subtract sales or revenue. We already know what sales or revenue is. So we just gonna write net profit before tax, we less revenue or sales. This amount, this one, revenue or sales, comes from here. We calculated revenue is 2.7 million. You just subtract 2.7 million. That's the first rule. Then from there, you go to your question paper, you check for net profit before tax. There it is. We have net profit before tax of 238,000. We're going to write it here, 238,000. From there, we eliminate separately disclosed items. On this part, we focus on interest received or interest paid or dividend income. From here, we're going to subtract, we less any interest received, or we add back any interest paid. Let's check for this portion first. Or now, what are we given from this two? According to our question paper, we have let me see, the finance cost. This finance cost, in another way, is what we call the interest expense, which means it's the interest paid. This one, the finance cost, which means we're gonna add back, because it was separate, it was previously subtracted. We now have to add it. From this, we add 95,000. Let's look for interest received. We have adjustment number 8 here. From this, we have the fair value adjustment on investment property. By the way, if something's an investment property, it means the business has to gain revenue from that kind of asset. So this one is like a fixed deposit, actually, according to me. So if you have By the way, and then they said it is the investment property at fair value. The fair value is the interest that we're looking for. This is the fair value, which is the interest. We have to subtract 20,000 from here. Is the interest received? You subtract 20,000. Now we check for dividends. We're gonna check if we have any dividend income. If there is, we must subtract it. You will now check for dividend income if it's there. Dividend income, according to the question paper, I've never seen in, yeah. We don't have any dividend income basically on this question paper. So we're gonna put 0 here. From there we go to non-cash items. We now have to eliminate the non-cash items. From those, the first one that we must have, depreciation. It will always be there. Depreciation, it was an expense. You now have to add it back. You have to add depreciation. According to the question paper, depreciation, they told us here, from distribution expenses, depreciation of 90,000 is included. You add it back. You add back 90,000 for depreciation. From there, you focus on, is there any loss on the scrap of an asset or profit, credit losses, loss on inventory. Now let's check. Loss on scrap of an asset. We go into the fixed asset that we have. Let's check. Vehicles. During the current year, a delivered vehicle with a cost price of 180,000 and accumulated depreciation was sold at a profit. They already tell us we have what we call the profit on sale of asset. This one. We have to subtract it. Let's start by it. We will then have to subtract or less the profit on sale of, let me just indicate it, on sale of vehicle. It's there on adjustment number 8. There is it, 12,000. We subtract 12,000 and then we check if there is any scrap of an asset. But according to the question paper, while I was looking at it, there is no scrap and there is no loss on the sale of an asset, which means from here basically we are done, because we don't have any loss on inventory. We don't have any credit losses like here. We don't have any credit losses here. It means even here we can have it. We go into working capital. For working capital, focus here is on the assets and the liabilities. Wherever when you see the assets, let the opening balances be positive and the closing balances be negative. So for cash paid to suppliers and customers, we only talking about inventory. We're talking about creditors. We're talking about accrued expense. We're talking about prepaid expense. No debtors control must be inserted from this one. So we'll start with inventory. We're going to talk about an increase or decrease in inventory. Let's check. Increase or decrease in inventory. I said the opening balance has to be added, the closing balance has to be subtracted because it's an asset. Let's check. For inventory, opening we have 570,100. So the opening we have 570,100 and the closing we have 530,000. From this to subtract 530,000. Let's see if it's an inflow or outflow. 570,100 minus 530,123. Let's see. We have an income here. It's an inflow of 40,100. We're done with the first part. These two, we're done with them. By the way, it can either be written in this way or this way, but now I prefer using this way because of if you know all of the assets, the opening balance are positive and then the closing balance are negative, for everything is going to be fine. We now focus on creditors. Let's see. Creditors, it will be under current liabilities. For creditors, we have the opening balance of 75,400. Like I said, let the opening balances for liabilities be negative and the closing balances be positive. We're not talking about creditors. The opening balance here, there is it, is 75 400. Write it as negative 75 400 plus the closing 71 200. So if we check on this one, they are paying, ne? They are paying. So if the difference between the two has to be an outflow. All right. So since we have